folks, Dan Frio here, the Mortgage Update. It is February 27th, 2020, and I hate to say it, but I truly hate to say it, but when I kept telling you pigs get fat, hogs get slaughtered, pull some money off the table because, you know, if somebody sneezes or something like that, the market's going to have a correction. And I was joking about the sneezing part, but I hate to say that part's kind of coming true. But we just hit correction mode. Once the market corrects or has a 10% decline, it says basically it's in correction mode. So I wasn't trying to fear monger. I wasn't trying to throw something out there. I just felt, and I've had some basically I had some major analysts on my show recently, and you're going to hear one coming up in the next couple of days. He was actually named one of the top wealth advisors in the country by Forbes magazine. He's going to be on my show this Saturday, and I had a conversation with him today, and he's, basically he was reiterating what I said. I had Steve Cortez, that used to be a trader on Wall Street for decades and now is one of the Trump advisors, and he was saying that about 2 weeks ago, that it's richly priced. And I kept saying, pull some money off the table, and unfortunately it's coming true. And the coronavirus is playing complete havoc on the market. So today what I want to talk about, I'm going to briefly go over what happened in the market. Rates are got a little bit better today, but a lot of investors, a lot of banks aren't really moving that much. And I'm going to explain why, and I'm going to show you a quick little article about that. Because now we're getting down to the banks aren't going to do mortgages at 0% interest rate, because these are 30-year. You're getting a loan for 30 years. So there's a threshold at some point where there has to be some money being made on the money being borrowed. So the banks can't basically go to zero. So let's go over what happened today. The stock market got clobbered, and it's basically fear of the unknown. The coronavirus, like they said, it's going to hit, basically the world, but how hard is it going to hit it? So let's go on to the news that happened today. Again, it's basically back to the coronavirus issues. And then let's go to some of the economic data that came out today. Is durable goods orders came in stronger than expected, but was still in the negatives. So we came in at a -2, which was better than what we anticipated as -1.2. So that's, it was bad, but not as bad as expected. Initial jobless claims came in 8,000 higher, which is basically not a big deal. I'm going to skip through, some of the other, information about the job markets for now. But the second quarter of GDP remained steady. Fourth quarter of 2019 at 2.1, which is good, but we're possibly going to throw all these numbers out the door, because this coronavirus is just playing havoc on everything. So we're not going to look at what happened in the past, because this is a very uncommon event that's taken place, and it's unprecedented. Nobody knows what's going to happen to this thing, and that's the biggest fear. The market corrected. It was down 1,100 points today. That's a huge move. The bright spot in all this is, people are holding on to the jobs, which, again, the jobless claims came in steady, but housing is just tearing it up. Why? Well, people were feeling more satisfied with their job, with the economy, and with a lot of other things. And, they hit record territories. In January alone, home sales were up 5.2%. That's a big number. Why? Again, people thought the economy, they have good confidence in the economy, in their jobs, in their wages. And mortgage rates, or borrowing of money, is cheap as, honestly, there's a lot of technicals out there saying, the MBS market isn't as low as it's ever been in history, but these are basically the lowest rates I've seen in my 32 years of doing this. So that's what we're going to focus on. Today, we'll see here, there was a pretty big move in the market, but there wasn't a big move in interest rates. And again, it's getting to the point now that, the lenders aren't going to go to zero. There has to be some profit being made there. And I'm going to go show you. Here's what the common question I got, and I'm getting right now, is we have a lot of loans pending. I think there's 60 or 70 loans we have in the pipeline right now. And, we lock some of them. Some people lock. Some people are closing soon, and they have to lock. I've been kind of on the fence right now, as you know, and as I broadcast every day. And some of the people that we did lock, they're calling now saying, "Hey, can I get a lower rate? Can I get a lower rate?" Then we have a lot of people shopping, and God bless you, shop. But the first question I always get is, "What is your 30-year rate?" And let me tell you this: there's a ton of different factors involved, and I'm going to show you. I'm going to pull the curtain aside a little bit and just show you the back end of what I do and how I find interest rates and how I scan the system for interest rates. But if the person comes out and says, "Oh, today's rate's 3.99," hang up the phone. Hang up the phone, because they don't know. There's probably 12 different factors that are involved in mortgage rates. So if they tell you that, they're giving you a false number, or they just don't know any better. You don't want to deal with somebody who just doesn't know any better, and you want to deal with honesty. The first thing I had, I don't know how many calls today, said, "Dan, what's your 30-year rate?" I said, "You know what? It's not great question. I don't know." And that's not I'm not trying to divert your question. Let's get the facts. Let me tell you, let's get all of our ducks in a row, and I'll tell you exactly what I can get you. But without all these factors, I don't know. It's like, here's my analogy I always tell people. Your car won't start. So you have a mechanic come to your house because it won't start, and he says, "Okay, well, let's open the hood." Why? He needs to see all the pieces of the components. Is there even an engine in there? If not, I can tell you why it's not working. So do you get what I'm getting with this? Is we have to know all the details before we can tell you or specify exactly what your rate is going to be. But let's get on to the charts that I follow every day, and we just busted above another line. And those who follow me every day, we watch the Fibonacci levels. It was here and here. Nope, it was here the other day and here, but now we just busted above another margin. So we're in basically uncharted territories, that we haven't seen in probably over a decade. Another factor is mortgage rates aren't tied to the 10-year Treasury, which a lot of people think they are, but that just hit uncharted territories. 1.30 was the lowest, I think, in recorded history. Now we just hit 1.29. That could be a resistance level. If we go below there, who knows where it's going to go. So the charts right now, let's plug in some details here. I mean, this chart's crazy. Rates are getting phenomenal. Where they're going to go from now, again, pigs get fat, hogs get slaughtered. But I don't see any reason why the rates are going to get any worse, but I really don't think they're going to get much better. Because again, there has to be a profit margin built into that. So here's what we watch on this channel. And again, my name is Dan Frio. I do the mortgage update every day. I have radio shows that I do in Chicago. I say shows because I'm on two different radio stations. I'm on one, it's WYLL radio. It's a Christian radio station in Chicago. And I'm on there every weekday, Monday through Friday at 7:30 to 8 p.m. It's called The Mortgage Update with Dan Frio. And we basically talk about mortgage, but that isn't the whole show. I have congressmen on there. I have financial analysts. I have CPAs. I have accountants. I have insurance people. I had an insurance person on the other day, and I was just asking common questions. What's a deductible? What's the this? What's the that? And a lot of things that you just wouldn't know. So it's basically like a financial show. And then I'm also on WIND radio. It's one of the biggest talk radio stations in the Chicagoland area, and I'm on there Saturday mornings from 7 to 8 a.m. And again, on there I have congressmen. I had Steve Cortez the other day. He's a financial analyst. Was on Wall Street. Now he's an advisor of Trump. I had Dean Hedeker. He's the principal of Hedeker Wealth. He was just named one of Forbes' top wealth advisors in the whole country. He just got awarded that last week. He was on my show. He's coming up. So those are the kind of people that I have. Basically, what's in it for you? I want to educate people out there, and I want to give you the facts. It's not a right-wing show, a left-wing show. It's not fake news. It's basically we tell you as it is, and we give you the truth. So that's what I do. And at the end of this, I'll tell you how to get a hold of me directly, and I'll make sure I can help you in any way that I possibly can. So what I want to do is, and here's kind of what prompted me to do this, kind of pull the curtain aside. Lowest rates in 8 years, but all kinds of disclaimers. Okay, what that says is mortgage rates hit an 8-year low. Again, I haven't seen these rates, I can't remember in my lifetime, and I've done this for 32 years, depending on the lender, right here. Just narrowly edging out the rates from July of 2016. There's multiple caveats. However, first off, lenders are responsible receiving to recent market movements in different ways. Some lenders move down faster and then blah, 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 blah. So, you know, we're hitting a point, I think, even if the MBSs keep going up in price, we're not going to really see that dramatic difference in rates. So let me explain this real quick for those new on the channel. This is what we follow here is the MBS market, the mortgage-backed securities market. This is a price of the mortgage bonds. And it's basically the more you pay up for a bond, the higher this keeps going, the more that the price of that bond is, the more money you're paying for it. Thus, if you're paying more money for a bond, you're getting a lower rate of return on your investment. So you're getting a lower interest rate. You're getting a lower now mortgage rate. So these aren't going to go to zero. You know, this could go to zero, but you're still going to have banks needing a profit margin if they're going to lend you the money, just for the paperwork and everything else that is entailed to that transaction. Okay, so now let me get on to interest rates. This is kind of, some people in the mortgage business might be a little ticked off at what I'm doing here, but I want to show you behind the scenes how this works and how we work it. I think we're much more technical than a lot of places. But let's go to this thing. Here's a search engine that we use. Okay, and let me move the screen down a little bit. I didn't put my picture in here today because I wanted to make sure I could fill up the screen as big as I can. So I already started this process. So I'm doing a $250,000 loan on a $350,000 home, which is 71% loan to value. It's if you take 250 divide by 350, it equates out to 71.43. That's the loan to the value, divided by the value. That's where we come up with this. The transaction is a purchase, so there's no cash out. The credit score is 740, and the debt ratio, and I won't go over this with you. You don't need to know this detail really. I'll tell it to you. The debt to income. So it's your debt divided by your income, and the debt used is anything on your credit report. All right. I put in here it's 555 Main Street in Anytown, Illinois, and give you the details. Okay, so what I want to do with this one is let's go to here, and I'm going to say, what is my rate on a conventional loan? Okay, let's do this. What is it on? I'm going to get a conventional loan and an FHA loan. So I scroll down and say, okay, find me the best rates out there. So it searches, 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 and now it pops up. And here's all the investors and the rates. So this is scanning all over our systems, trying to find the best rate out in the market. Okay, so now we're going to go to the 30-year fixed rate, because I looked at 30 years for the FHA and conventional. So let's start here. The 30-year fixed rate on Ginnie Mae 2, which is an FHA loan, is 3.5. And then there's some pricing over here. So look at all the differentials in pricing, or my rates. I'll say rate. 3.5 all the way to 4. The exact same criteria that we had up above. Okay, exact same criteria. I didn't change any of that. I just changed what, now it says, it scans all that details and says, here's all the programs that it qualifies for. All right, so now we go through here. There's Home Possible programs, there's Home Ready programs, there's all kind of other smart programs. This is what your loan advisor should know. So when I say I'm a loan advisor, I'm going to let you know the programs that you qualify for. Not only those, what's best for you. Okay, so now this is what will pop up. They'll say these are all the programs you qualify for. All right, so now I need to know in detail what all these programs are, because you might qualify, you might not. All right, so that's that. So over here is the interest rates. You can see they vary from 3.5% to 4%. And then over here is what's called the price. So let's go to a 30-year fixed rate. This is just the normal 30-year fixed rate. I'm going to show you something. This is behind the scenes and how this stuff works. So now you have all these different rates. Look at the rates. They go from 2.875 to 5.99. All right. So right here, if you wanted to get a 2.875 rate, which would put your payment at $1,037, you would have to pay 2.782 points, is what we call it in the business, or discount points, what might show on your rate lock. Or the best way to do this is percentage of the loan amount. So it's going to cost you 2.782% of the loan amount to get this rate. Or that comes to $6,955. So yes, I can get you 2.875 rate if you want to spend $7,000. Probably wouldn't advise you to do that. Okay, so as the rate goes up, you're going to notice these numbers start coming down to zero and then go into the negatives. All right, so for example, at 3.375, this would be what your payment would be. It would cost you this amount, 0.331 discount points, or in this equation, $828. So that's how to read this. So now there's negatives here. So people say, "What, Dan, what's the negative?" Well, great question. How do lenders tell you that they're going to do your loan at no cost? You know, we're going to give you the best program in town. It's a no-brainer. We're going to get your loan done at no cost to you. Well, what they do, and probably the average cost out there is about $2,000. So they're going to come back to you and say, you know what, we can get you 4% at no cost. So they're going to give you a credit for $2,102 in this case. That's how it works. So they're not really giving you anything for free. They just raised up your rate and they're giving you a credit. That's what this is. The negatives would go back to you as a credit. Think of it as a rebate check. And the positives is what it would cost you as the borrower to pay to get this particular rate. All right. So that being said, I hope you understand this part of it. So what we try to do is try to get right in here. Like in this case, I'd go to the person, well, you could pay $828, or you can get back almost $100, and the difference in your payment is $18. So what's the break even? And there's a lot of like number crunching that I do, and I'll come back to you and say, you know, here's what I would do. And you know, it might behoove you to, you know, pay the $800 because you're going to save $18 a month, but it's going to take you, you know, so long to recoup these fees. Okay. So now that being said, let's go back for a second. Oh, no, let's stay here. So that is the conventional loan. So now, Ginny Mae, this represents FHA loans. So now let's click this and see behind the curtain on this where these numbers come out. Okay? So in this case, you can get 3.5% and still get a rebate check back for $390. Okay, so look at this. Let's compare these two. 3.5 and you're getting back $390. 3.5 and you're getting back $98. So you might say, well, Dan, I want an FHA loan. Well, maybe not. FHA charges a fee. Any lender you go to is going to hit you for this, and it's 1.75% of the loan amount as a fee. So when we factor that in, this might not be the best way to go. That's why your mortgage advisor needs to know what they're doing. They can't just plug in the system. Let's say you get a mortgage advisor and they plug all the data in. They're like, I don't know which one of these to pick. Let's just, this is the lowest rate. Let's go with this. Well, it might not be, because the FHA loan in this category, if we did a $250,000 loan, what is 1.75% of that? Here, hold on. Let me grab a calculator. Bear with me 1 second, because I want to give you the facts. Again, I try to educate everybody as much as I can. 250,000 times 1.75% equals it would cost you $4,375 to do it under this program versus the other one. Well, you probably don't want to spend $4,000 to save, $10 in the payment, so you would go with a conventional loan. If your mortgage advisor or loan officer puts you into this program at 3.5, you just spent $4,300 and for no reason. I mean, because here you're getting $98 and here you're getting $390. So you got a $300 more credit, but it cost you $4,375. So you still spent $4,000 more than you needed to. That's what I'm getting at. Okay, so now let's do something. And here's what blows everybody's mind. Okay, so now let's say we need a $300,000 loan, right? And it goes up to 85%. That's too much because we can only go to 80%. I'll show you why here in a second. Let's do this again. So now we're at 78% loan to value on this transaction. And we're going to say, you know what? How about I get out? I want to pull out cash. Okay, and I want to pull out $10,000 in cash. And my credit score is 620. And everything else is the same. All right? Let's do the interest rates on this. So remember, our benchmark last time was about 3.5%. So now, oh boy, I only qualify for the Ginnie Mae, which is the FHA loan. So now we look at the pricing of that, and we go down to as close to this as we can. It's 4.125. Well, holy moly! When we did the purchase at the $250,000, we were at 3.5, getting a rebate. Now 3.5 is going to cost us $2,000. Okay. So now let's change it one more time. I hope you get where I'm going with this. Now let's just change the credit score. Now we're at 740 instead of a 620. What's that going to do for us? Well, now we can go back to the 3.5% on the FHA. 3.5. But look at this. The 30-year fixed conforming rate is now, oh, I'm still in FHA, 4.125. Okay, it's all over the map. So now let's do one more thing. And I know I'm not trying to beat a dead horse here, but I want you to get it. So now let's change this from a single family to a condo, and let's keep everything the same, just for kicks. Let's change this to a 680, and let's make it an investment property instead of your primary home. So what's going to pop up this time? Can't even do it. So if somebody tells you the rate's 3.99, well, they might not even be able to do the loan. Let me make one more different tweak on this thing, because I knew that it wouldn't run because you can't get an 80% cash out on an investment property. Let's put this at $150,000. And now this loan to value, 150 divided by 350 is 42. Now let's go down and see what we can get there. Now we can get a loan, but miraculously, the best rate in town on this one is 4.75. Remember, we started at 3.5 and all this. Now this would cost you $3,000 to do it in this scenario. That's what we do. So if your mortgage advisor doesn't know what they're doing a disservice to you. So I'm going to leave it at that because I just went over 20 minutes and I hate doing that because of everybody's attention span. So I hope you get it. So if I can be of any help, you want to reach out to me, let me help you. I'd love to help. You can reach me at 844-775-LOAN, which is 844-775-5626. You can email me at Danny, DANNY, Frio, and Frio is FRIO, at preferredrate.com, or check out thefrioteam.com. And I've been saying this, and I'm getting gobs of these things. If you're in the middle of a mortgage now, you have to get legally what's called a loan estimate. And that goes over the rate and the fees. So don't be wowed over the rate, because I can say, I'm getting you a 275 rate. Nobody will beat that. Well, if you're spending $8,000 to get that, I would highly suggest you don't do it. So don't be wowed over the rate. We want to make sure the costs are in line with what you should be or should not be paying. Email me your loan estimate at, again, danny.frio@preferredrate.com. If you have a mortgage now, send me a copy of your mortgage statement. Let me see. Let me run some details on it. I'll probably call you and need some information, but I'll run this scenario for you. We'll search everywhere, get you the best rate and best costs in town. So I hope you like it. Please don't forget to give me a thumbs up. Please subscribe down below. Leave some comments. I'm up to date on every one of my comments, and I'd love to help you. So God bless. Thanks again. Sorry I'm over 20 minutes, and I'll be back tomorrow, same time, same place. See you then.